Hey everyone, welcome back to Corporate Decoder, the place where we sometimes find out that companies are borrowing more money than maybe they should be borrowing. Today we are diving into a recent filing from Store Capital LLC, an 8K report that dropped on the 29th of September 2025. This is just any report. It is a peek behind the curtain at some big financial moves. Stick around to decode what it all means for the company and potentially its investors. And before we dive in, if you are all about cutting through the corporate jargon and getting to the real story, hit that subscribe button. We also built a fantastic community over on Discord. The link is in the description below. It is a great place to chat about these filings and more after watching. So what is the big news here? Well, on the 29th of September of 2025, Store Capital LLC, which we LL just call the company from now on, announced they entered into a significant agreement. It is called the Amended and Restated Unsecured Credit Agreement. Think of it like this. They had an old loan agreement and they gone back, revamped it, and essentially signed a new, bigger one. Under this new agreement, they secured a revolving credit facility. That is like a flexible line of credit. This one is massive, a cool $1.25 billion. Part of that includes a $200 million swingline subfacility, which is for very short-term loans, and a $75 million letter of credit subfacility, which is like a guarantee for certain transactions. On top of that, they also making available senior unsecured term loans, which are more traditional loans, totaling a hefty $1.65 billion. So in total, the company has significantly increased its borrowing capacity. They've also managed to extend the maturity dates for these borrowings, which means they have more time to pay it all back. The terms and conditions are pretty similar to their old agreement, including interest rates and what we call restrictive covenants. These are rules and limits the company has to follow, like maintaining certain leverage ratios, cash flow, and debt service coverage ratios. Essentially, they re-promising the lenders that they'll keep their financial health in check. Now, if that wasn't enough financial activity for one report, there is more just a day later on the 30th of September 2025. The company completed something called the 2025 Master Funding Transaction. This involved the issuance of $645 million worth of notes. These are basically ISCs, but structured in a specific way for institutional investors. The notes were issued by several special purpose subsidiaries of the company. Think of these as separate legal entities created by the company to hold assets and issue debt, designed to be separated from the main company's financial risks. Out of the total $645 million, $625 million were issued as Class A notes to qualified institutional investors. These are typically large financial institutions that buy in bulk. The remaining $20 million were issued as Class B notes, and these were kept by an affiliate of the company. These Class A notes were sold to initial purchasers, under a note purchase agreement signed a few days earlier, on the 25th of September 2025. The company and its subsidiaries sold these notes in reliance on exemptions from registration under the Securities Act of 1933, meaning they didn't have to go through the full, lengthy process of registering them with the CC for public sale, as they were sold to sophisticated investors. Let's take a quick look at the breakdown of these notes. They issued these in 7 different classes. We have Class a -1, a -2, a -3, all rated AAA by S&P Global Ratings, which is the highest possible rating, indicating very low risk. These have initial principal amounts ranging from about $107 million to $160 million. Their interest rates are competitive, and their anticipated repayment dates span from September 2030 to September 2035. Then we have Class a -4, a -5, and a -6, all rated AA, still very strong ratings. These range in principle from around $17 million to $44 million, with slightly different interest rates and repayment schedules, also spanning to 2035. Finally, there is the Class B note for $20 million, rated A. This one has a higher interest rate of 6.14% and is also due in September 2035. The weighted average interest rate for all the Class A notes combined is about 5.06%. This whole transaction is essentially how the company plans to fund its growth. The Class B notes held by an affiliate might be sold later. These notes are governed by a master indenture, a deep legal document outlining the terms and conditions, and a Series 2025-1 supplement which is specific to this particular issuance. The company and its subsidiaries can issue more notes under this indenture in the future. These notes are specifically secured by the assets of the issuers and any co-issuers. The indenture also lays out what constitutes an event of default, like non-payment of interest or principal or significant breaches of the agreement. It also details early amortization events. These are situations that could trigger sooner repayment, such as a drop in cash flow coverage ratios, or failing to repay a class of notes by its anticipated repayment date. If these events happen, it could lead to early repayment or even the liquidation of the collateral. To manage all these new financial arrangements, the company also entered into an updated property management and servicing agreement. In this setup, the company itself acts as the property manager and special servicer, responsible for overseeing the assets that back these notes. KeyBank National Association is involved as a backup and sub-manager, handling the collection and remittance of payments to the indenture trustee. The subsidiaries issuing these notes are still subject to restrictive covenants, limiting the types of businesses they can be involved in, which is standard for bankruptcy remote special purpose entities. This next item 2.03 basically just points back to the information we just discussed in item 1.01, confirming that these new credit agreements and note issuances are indeed direct financial obligations of the company. Nothing new here, just a cross reference. And finally, item 7.01 is a standard disclosure about public announcements. On the 30th of September 2025, the company issued a press release to announce this offering of notes. A copy of that press release is attached as an exhibit. Any information provided in this section is not considered officially filed with the CC for liability purposes. This section just lists all the documents that are being filed along with this report. This includes the credit agreement itself, the indenture supplement, the property management agreement, and the press release we just mentioned. Plus, there is an interactive data file. Looking at the entire picture, what does this tell us about Store Capital LLC? They're clearly in a growth phase, and they are using significant debt to fuel that growth. The immediate takeaway is that the company is actively managing its capital structure, borrowing substantial amounts both through traditional credit facilities and through securitization vehicles. The successful issuance of these notes with strong ratings suggests that investors have confidence in the underlying assets and the company's ability to manage them. However, with great borrowing power comes great responsibility. The increase in debt means higher interest payments and a greater financial burden. While the interest rates on the A notes are around 5.06% on average, which seems reasonable, the sheer volume of borrowing, both from the credit agreement and the notes, raises the overall debt load significantly. Warren Buffett always says it's important to look at the total debt a company has. He'd want to see if the company's earnings can comfortably cover these new obligations, especially through economic downturns. The fact that the Class B notes, which carry a higher interest rate, are retained by an affiliate might be a strategic move, perhaps to keep more control or to potentially sell them later at a better time. The restrictive covenants in the property management and indenture agreements are standard but important to keep an eye on. They ensure the company stays focused on its core business and doesn't take on undue extra risk within these special purpose entities. The overall direction for Store Capital LLC appears to be one of aggressive expansion funded by debt. They are accessing capital markets effectively, evidenced by the strong ratings on their issued notes. The key risk here is the increased financial leverage. If the underlying real estate investments don't perform as expected, or if interest rates were to rise significantly beyond what is currently priced into these notes, the company could face significant challenges in servicing its debt obligations. On the positive side, this massive influx of capital is designed to fuel growth, which, if managed well, can lead to increased profitability and shareholder value in the long run. The company is also layering in management agreements that seem designed to protect its core operations and its lenders. In conclusion, Store Capital LLC is making big moves to secure significant funding for its future. It is a strategy that carries both promise and peril. Investors should definitely keep a close watch on how this new debt impacts their future earnings and financial stability. Alright, that is our decoder for Store Capital LLC's latest filing. What are your thoughts on this massive borrowing spree? Do you think it is a smart move for growth or a risky bet? Let me know in the comments below. If you found this breakdown helpful, please hit that like button to support the channel and subscribe if you haven't already for more in-depth corporate analysis. And don't forget to join our Discord community linked in the description to continue the conversation. Thanks for watching, and I'll see you in the next video.